Hey guys, welcome back to the series of candlestick patterns, and in this video I'm talking about the island reversal pattern. Let's have a look at what the textbook says about the island reversal pattern. We'll have a look on there, we'll draw it on the board, we'll kind of work out the strategy and the theory behind it, get some idea of where we might see it, how we might be able to take advantage of it, and whether we think it's going to work for us. Okay, so let's draw it on the board exactly what an island reversal is. So island reversal is generally, I'm not going to draw all the candles here. You've got an uptrend move here. You get a gap up and you get a cluster here of candlesticks. Now to me, they can be any type of candlesticks. But the point is you then get a gap lower and price moves lower. So I'm going to colour these in whatever, but I don't think it actually matters. We'll double check in a minute what the textbook says about this. Maybe they have a strict rule, but not that I listen to textbook so much. But it's interesting to see what the definition is. Okay, so the theory of this is a bullish island reversal. Just flip it on its head for a bearish island reversal. The theory of this is that we get a good drive to the upside. Something causes price to break away, have a breakaway gap or an exhaustion gap, whatever you want to call it. Obviously in hindsight, it's an exhaustion gap, but at the time, you don't know. If you just kind of say, well, look at that there. If I can cover that, hopefully you can see that. It could be a breakaway gap, right? Forget about the color of that for now. I don't think the color matters so much. And also the number of the candles doesn't matter so much. You can have that 4 or 5 days or whatever it may be. The point is it's an island of price. Different to an abandoned baby. An abandoned baby is just one, and it's generally a doji or very, very small candle. This could be, you know, a decent range as such. It doesn't necessarily have to be small range. Often it is because of the nature of what's happened to get there. But the point is you've got kind of a few phases to it. You've got phase 1, which is this move up. You've got phase 2, which is the gap. Phase 3, which is the cluster of price. Phase 4, which is the gap lower. And then phase 5, which is the subsequent downtrend. Let's talk our way through. Good bullish demand, good demand coming in, supplies being overcome by the demand, pushing up. For whatever reason, phase 2, we get a gap up. Gap up leaves a gap, literally a layer of price that's not traded out at all, and we start to do some business, start to do some work in the day, the next day up at highs here. That's fine, we close there. The next day we kind of open up in that range again. The next day we open up in that range again. Maybe we move to new highs, maybe we do some work in the lows, but the important thing is for the criteria is that that gap is not filled. That's the point of it. You have the island of price that's completely independent of the rest of the move. Great, all looks fine, bulls are very, very happy with it, all looks good. Then all of a sudden something comes out that reprices that, then we get a subsequent gap, this time to the downside, gaps lower and leaves a gap, an island of price up there. And that's ultimately why it's called an island reversal. It's just a cluster of price, but it's on its own. There's no trade up towards it, there's no trade down below it. It's just a gap, and then for whatever reason, a gap lower. Now, if you think about how you would get this kind of thing, often this is going to be news related, guys. You've got something, a stock has gapped up for whatever reason, caused a little bit of action, then all of a sudden there's some negative news and causes it to back down. You've got to remember that every single person who's been buying up here is now trapped in it as the gap moves low, and very often you're going to get very aggressive down moves afterwards because of that, because not only are people trapped, but there's going to be people liquidating it from whatever reason. And generally speaking, I would suggest to you that the fact there is a gap lower indicates that there is a reprice scenario, is some sort of catalyst that's causing that, which potentially is going to cause a multi-day reprice in whatever instrument you're trading. That's my kind of theory on it. Let's have a look from a intraday perspective how this would look. So let's look at the final day here, sort of a classical, low to high move. Then we get a gap up and we kind of do some trade up here on that day. The next day maybe we do some trade like that. Next day we do some trade like that. Then the subsequent gap day, which is number 4 here, we gap lower and we're going to have a high to low move. Again, several days, doesn't have to be 3, doesn't have to be 4. Don't think there's a specific thing on this. We can have a look and see what the textbook says. Do they say anything about specific thing? Maybe they do, but I'm not going to read the whole thing. Go and have a look at it, and if you've got any comments or any thoughts about how many really you should have or whether that pattern's right, then I appreciate the comment, leaving a comment in the section below. But then that's the theory behind it. How would we trade it and what we're going to make our entry? Obviously this is a bearish pattern, so we're kind of looking for, and we don't really get the gap we don't really get the confirmation. It's not many of these patterns we can kind of front run them a little bit naughty to do that, and some people are like going, you can't front run stuff. Yeah, I kind of get that, but sometimes you can. You take the consequences of being stopped out more often with the more risk reward that you get from it. This one you can't really, because it doesn't become an island reversal until you finally get that gap lower. You know, at that point in time, it's just a breakaway gap, and I've seen, you know, plenty of charts out there that have that gap cluster maybe after earnings and then just carry on and on. So it wouldn't really make sense to do that from a bearish perspective. You need to wait for this. There's your final thing there. I guess you recommended way for the textbooks would be to go short there and to have perhaps a stop above either the island, or if that's pretty too far, which potentially it could be, you know, could be talking pretty serious here, then maybe you're going to have to quantify it and have it somewhere up there. Where would you have it? Where would a good place to? Let me know what you think about where a good place to have a stop with an island reversal, how you trade that. Obviously, you've got to kind of get the meat of the trade, but you've got to try to cap your risk somewhere. The obvious one is above the high, but if that's too far, where would you put your stop? Be interesting to hear what your thoughts are on that one. I guess intraday you could do it. You could sell at the open, and then if later in the day it undoes that, then you kind of come out of it and just manage it intraday, but look for a swing trade perspective. Anyway, guys, that's the island reversal. Let me know your thoughts on that. Do you use this? Do you like this pattern? Do you look for it? Do you scan for it? Do you think it's rubbish? Do you think it's any good? What markets does it work for with you? Have you got a little twist on it that you kind of integrate with your own trading that works very well? Love to hear what your thoughts are on that in the comments below. If you like this video, give it a thumbs up. And if you haven't already, please subscribe for more charting, candlestick patterns, technical analysis, strategy, discipline, setups, all that kind of good stuff to help make us become better traders. Good trading out there, guys. Manage your risk. See you at the next one. Take care.